Now, hello to all the Wall Street Cubs. Welcome to Introduction to Quantitative Stock Analysis from InvestRight. Before we get started, here's a little quote you should consider. Someone's sitting in the shade today because someone planted a tree a long time ago. This is stated by Warren Buffett, and it emphasizes the importance of long-term investing. In this educational module, we'll be covering intrinsic value, we'll be recapping it, and what some of the basics of fundamental analysis are. Then we'll get started on qualitative factors like ESG. We'll then move on to financial statements and talk about ratios. So what is intrinsic value again? So intrinsic value is just a measure of fair value of an asset. There's no concrete standard or anything to determine intrinsic value, no magical formula that'll tell you a number right away. Analysts, investors like yourself, they need to build their evaluation models based on certain qualitative and quantitative factors. So we know how to get those qualitative factors. We can look at things like governance, business model, etc. And this can be developed using SWOT, so strengths, weaknesses, opportunities, and threats. We can also use Porter's 5 forces and many more that we covered in our last module. To find the quantitative factors, we have to look at financial ratios. Quantitative just means looking at the numbers. So there's very few models that can actually give you a number for a number or like a price for the intrinsic value of a stock. Most of those are extremely complicated and require a lot of math. But most commonly, we can compare companies to each other to find out their intrinsic values. So what is fundamental analysis again? Fundamental analysis is just the process of determining intrinsic value. We have qualitative models that we've learned that'll help us do this, including SWOT, McKinsey 7S, Porter's 5 forces, and Pestel, but we also have quantitative measures. These quantitative measures can come in the form of financial statements and the ratios that we derive from them. The first financial statement we have is the profit and loss statement, and it's structured in this way. So it'll have the revenue on top, then it'll go through the expenses of the company and then the profits of the company. So in these reports, it'll generally report a company's earnings and finances over the course of a year or a quarter, and tracking these kind of lets you have better predictions about the stock. To find financial statements like these, you can simply Google the company's name, like Tesla, and income statement, and it'll probably be the first result from something like Yahoo Finance or even just Google's own financial tools. So here's Tesla's income statement. As you can see, it follows the structure we stated in the slide before. You have our revenue on top, and then the document goes through the expenses. So we have operating expense, we have an other income expense, we have pre-tax income and things like that. Then it'll go through the profits and the total expenses at the bottom. As a side note, TTM just means trailing 12 months. So this will be the total revenue or profit or whatever number from the past 12 months in the year we're in.
Quick clarification from the profit and loss statements. You guys heard the terms revenue, expenses, and profits. Revenue essentially means how much money you're getting by selling things. So, for example, if a shopkeeper is selling an apple for $10, he gets $10 revenue for that apple. Expenses are basically how much it costs for him to get the apple made. So, if he needs to buy the apple from a farm, that's going to be $5. His expense is going to be $5. And profit is going to be how much extra money he gets by selling it. So that's 10 minus 5, which is 5. Now we can use these concepts as well to sort of look at another financial statement called balance sheets. So that basically means total assets, and it shows total assets, total liabilities, and shareholders' equity. So it provides an overview of a company's assets, liabilities, and the amount owned by shareholders. It can be, helpful for you to determine what a business is worth and how valuable it is. A quick recap: assets basically means something you have, something you own, that's something that's yours. Liability means something that is your responsibility, like a loan. You're responsible to pay a loan back. It's something that is not yours. And over here, current and non-current just means that what you own currently and what you don't own currently. For example, if you see a liability, current liability is going to be a loan you currently have. Non-current liability is basically going to be a loan you can foresee or an old loan maybe. So it can show red flags within a company, and you may not find it on a it can show some red flags that you may not be able to find within a quick Google search. And when a business is gaining money, when they have more asset, it usually is good. But when they have more liabilities, when they start losing their money, which you can also see in the profit and loss statements, that is bad. So as a quick example, Tesla didn't have a lot of money recently. Until recently, they had a lot of liabilities. But yeah, let's check out the balance sheet of Tesla now. So over here, you see their total assets, their total liabilities, which is quite high, like 26 million is quite high. And then you see a whole lot of other things, but you want to focus on the total assets and liabilities. And this, along with other financial statements, can really help you determine the value of a company and see how their balance sheet or how their assets and liabilities look.
All right, so now we have cash flow statements. And so a cash flow statement underlines the cash generated and used within a certain period of time by a company. And it allows a comparison between net income and operational costs of said company. This gives us insight into the efficiency of that company's operations. So here we have Tesla's cash flow statement. And as you can see at the top, there is the operating cash flow for the TTM, which, as Shantanu said, is the trailing 12 months or the past year from today's date. And then we have the investing cash flow, financing cash flow, and then the end position of the company.
So you guys checked out these three different financial statements, but the more important thing is financial ratios that you can derive from these, and they give us even more information about these different companies. So yeah, let's start with some basic ratios. So the return on equity is basically calculated by, calculating your net income by investing and divide that by the number of shares. So for example, if you have, excuse me, so it's used to calculate profitability and factors in some debt. For example, if you have a stock that you bought in at $50, but you sold it at $150, and you have say 400 shares of that, then maybe you can have 25 return in equity because the $100 in shareholder equity basically means the company has net income of $25. So this is calculated by taking the net income is calculated by taking the income over a certain period of time and subtracting, the net expenses and taxes generated in that same period. And this can be found in the company's income statement or profit and loss statement that we just went over. So if return on equity is say 25% and the average shareholder equity is $100, then the net income is 25. So this is an important metric of the profitability of a company compared to the shareholders' equity. Now, return on investment is a pretty common phrase used in daily language as well, and it's used to calculate the profitability of an investment compared to your other investments. This is calculated by subtracting the cost of the investment from the final value, basically what you paid for a stock and what you sold for a stock. And you divide that by the initial cost. So this will give you a ratio, and you turn that into a percentage by multiplying it by 100. For example, if you bought $50 worth of share of a company and another $100, you sell it at $100 and you get a profit of $50 because 100 minus 50 is 50. And you divide that by the initial cost of 50, you get 1. 1 is to 1. Now you multiply that by 100 and that becomes 100%. So your return on investment percentage is now 100. Here are some more important trading ratios. For example, the price to earnings ratio, which basically shows the relative values of different companies. So it's calculated by taking the share market value and dividing it by the earnings per share. This will indicate the value of a company basically. For example, if the PE ratio is high, then the stock is really overvalued and is expecting high growth. While if the PE ratio is low, the stock is undervalued and could be a candidate for value investing. We'll go over investing strategies more in the future where you're going to see more usage of this PE ratio. But for example, it just essentially shows how expensive a company is. If you have a PE ratio that's really, really high, that means their price, their stock price is really high compared to their actual earnings. And we want their earnings to be high as well. For example, Tesla has a really high PE ratio because, as we mentioned, they're not really profitable and they're just starting to get profitable. So their sky high stock price is quite expensive for that stock. Whereas if you look at Coca-Cola, their PE ratio is relatively low. They're priced pretty reasonably, maybe even cheaper than what their actual worth is, because they say have really good earnings because of the amount of Coca-Cola they sell. Now, price to earnings to growth or PEG ratios are really similar to PE ratios, but they have an added level of complexity. To find the PE ratio, you will take the calculated PE ratio of the company and divide that by the growth rate. You can find the growth rate on analytical websites, and this allows you to have an even better way of, comparing companies by taking the expected growth or how fast a company is growing or becoming bigger. And with the price to earnings, a low ratio, similar with the price to earnings ratio, a low ratio over here means that the company is in fact undervalued.
All right, so qualitative ESG analysis. What does ESG analysis mean? So ESG stands for environmental, social, and governmental. And so the environmental criteria may include a company's energy use, waste, pollution, natural resource conservation, and treatment of animals. The criteria can also be used in evaluating any environmental risks the company might face and how the company is managing those risks. For example, are there issues related to its ownership of contaminated land, its disposal of hazardous waste, its management of toxic emissions, or its compliance with government environmental regulations? Social criteria looks at the company's business relationships. Does it work with suppliers that hold the same values as it claims to hold? Does the company donate a percentage of its profits to the local community or encourage employees to perform volunteer work there? Do the company's working conditions show high regard for its employees' health and safety? Are other stakeholders' interests taken into account? Now, with regard to governance, investors may want to know what a company uses know that a company uses accurate and transparent accounting methods and that stockholders are given an opportunity to vote on important issues. They may also want assurances that companies avoid conflicts of interest in their choices of board members. Don't use political contributions to obtain unduly favorable treatment, and of course, don't engage in illegal practices. Basically, ESG is a framework of thinking that allows investors to think more about the company's impact on the environment. And also, a company's standing with the public can depend on ESG factors. This will help you pinpoint a company's ethical or environmental issues that will eventually affect the stock price. Now, we'll get into some tips using MarketWatch. So the different types of stock orders are limit orders, stock orders, those being limit orders, market orders, and stop orders. So a limit order is a request by an investor to buy or sell the security at a certain price in the future. And this guarantees that the order will be fulfilled at or at a better price than this price you specify. But this does not guarantee when or if the order will be filled. Then we go into market orders. This is just buying or selling of stocks at the current time and price, where you'll just click the sell button to sell or the buy button to buy the certain quantity you want. And this guarantees order execution, but not the time or the price it will be sold at. So basically, this is just your standard stock buy or sell. And now stop orders are in order to buy or sell when the price passes a specific point. This can limit loss, but it also reduces earning potential. And this will usually be used when an investor or trader can't get access to their portfolio for a long period of time. For example, if they're traveling or if they'll be offline for a while. This is also used when trading extremely volatile assets like cryptocurrencies, which can have massive price changes in very short periods of time. And thank you everyone for listening. And be sure to reach out to us either through email, social media, or on the other platforms if you have any questions.